Hi, and welcome to today's class, where we will be covering analytical review. Analytical review is concerned with applying a range of techniques to highlight significant or unusual items in the financial statements. Analytical procedures are a substantive test. They look at dollar values. Analytical procedures are techniques used to highlight trends or relationships in the balances in the financial statements. They are used for risk assessment in the planning stage, to help determine the nature, timing and extent of tests, as part of substantive procedures, as relevant and reliable audit evidence to substantiate accounts. Their effectiveness depends on the nature of the assertion, the plausibility and predictability of relationships, the reliability of data and the precision of expectation. And also they are used near the end of the audit to assess conclusions reached and evaluate overall financial statement presentation. The review can be based on comparisons of clients' draft figures together with figures from previous years, estimates, or industry estimates. Types of analytical review. Simple review uses comparisons, ratio analysis, and size analysis. Basically, you would use ratio analysis to compare the current figures with previous year's figures or estimates. Then an auditor would investigate significant differences from the expected rates or balances. The limitations of an analytical review include the guidelines for evaluation may be inadequate, for example, whether the industry averages is good or why the balance should be the same as last year. It is difficult to determine if a change is due to misstatement or as a result of random changes in the account. Accounting differences may hinder comparisons between companies. Some companies may use different methods to value stock or depreciate assets, for example. Analytical review will present only circumstantial evidence. Further audit testing will be required. Types of analytical review. Here are some common ratios. One ratio is gearing ratio, and it is used for the analysis of deferred liabilities to total equity. We have the current ratio, or otherwise known as the working capital ratio, which is current assets to current liabilities. Equity ratio, which is total shareholders' equity to total assets. Return on total assets, or return on shareholders' equity, which is either profit to total assets or profit to shareholders' equity. Stock turnover is the cost of goods sold to average stock, and debtors turnover is the average time to collect. Debtors to sales multiplied by number of days in the period. Average days to sell stock is the cost of goods sold to average stock. Gross profit ratio is the gross profit to sales. Operating ratio is the cost of goods sold plus other operating expenses to sales. Operating expense ratio, cost of goods sold to sales, finance expense to sales, admin expense to sales, or selling expense to sales. And finally, the net profit ratio, which is profit to sales. Ratios can vary depending on the accounting firm, and many firms do not use averages. So in practice, analytical procedures have the following steps. Step 1. Compare last year's figures with this year's figures and determine the percentage change. Step 2. Calculate some of the more common ratios and look at percentage change, as previously mentioned. Step 3. Decide what is normal for the company in question. And finally, Step 4. Identify and analyze significant differences and unusual relationships. Thank you for your time.